All right. Good morning, JP.
Morning, Brandon. How are you?
Good, 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 good. I cannot believe it's December already.
I know we were just talking about that. This year has completely flown by.
Yeah, and so has this week. So I was thinking today we could do our market predictions for 2023.
Okay. For to close out the year.
Yeah.
So, how deep are we going? Is this going to be like, is it up or down, or do I have to call my shot? How does this work?
No, no, I mean for the last 11 months, actually. Yeah.
Okay. Got it.
Yeah. Because here at Conscious Wealth, we do not predict the future. We're looking at value in real time. But
Right.
there is some value or it makes sense for us to look back at everything that happened this year.
Yep.
Um,
And
so I
what do you?
thought we'd do that today.
Yeah, I think that's a great idea. It's been a really weird year. When we were kind of getting ready for this video, I was like, "Do you remember when this happened? Do you remember when that happened?" And it's like so much has happened in one year that's almost hard to wrap your brain around it.
Well, we had a mid-market banking crisis.
Yeah, this earlier this year, we had to call people and have a real conversation about how the FDIC works and protect everyone's cash. That hasn't happened in decades.
Nope. Nope.
Oh,
And yeah, that was a real one. We had
mm-hmm.
a 17-year low in the bond market.
Yep, we did. And now bonds are back as an asset class that provide legitimate income and long-term returns. So that's a fundamental change in portfolios.
We've I
You
don't know
wrote
how many
you wrote
rate
a
hikes.
letter with a chatbot this year.
Oh yeah, yeah.
How
And
about that as a change?
Chat GTP came out.
Yeah.
I mean, I know it's been around for a while, but it was actually officially launched.
Mm-hmm. Yep,
It's been a wild year.
it
It's
has.
been a wild year.
Yeah,
Uh,
and
yeah,
what was more wild about this year was actually where we came from last year. So it's okay. I want to start and just kind of flash a chart up to remind everyone kind of what happened the preceding year, which I think we've all already kind of forgotten about.
go for it.
Yeah. So sharing my screen here. Last year was one of the worst years in the stock market since I've been alive. So looking back at it, the S&P 500, which is kind of the normal benchmark for the US, was down 19.4%. That's a price level, so it's like 1% better if you add in dividends. But you can see even the Dow, which historically is big, large blue chip companies, had a horrible month about May and really fell off. Technology was down as much as like 30% ish at its lows. And so the whole time this was happening, Brandon, we didn't even have a recession. We just had this really weird, bad bear correction of a year.
Yeah, that's and these things happen, and everyone came into the new year. And I know we've said this before, but it's so
Mhm.
important. All of the major firms came in and said 2023 we're going to have the recession. There's no soft landing. No
Right.
soft landing. Soft landing doesn't even exist.
Mhm.
And now they're all kind of saying, well, maybe a soft landing can happen,
Yeah.
as we're seeing employment levels start to equalize, as we're starting to see inflation come down.
Right. Right.
Um,
And I
yeah,
have a
go
couple
ahead.
of shirts on that. Yeah.
Oh,
So
cool.
that's a great point. So I think really last year, inflation in 2022 really was getting to its ultimate peak, in absolute terms, but also year over year. But really the way to combat that historically has been the Fed raises interest rates. And so if we look over on this chart on the right, the effective federal funds rate is now at about 5% or a little bit over that. And so as rates were going up, I think everyone was kind of waiting with bated breath for something bad to happen. And lo and behold, nothing too bad has happened, right? So we had, like you said, the bank collapse. But that was a limited in scope thing.
So back to when you said that, waiting with bated breath to see if something bad happens. If you look at consumer sentiment, it's really low.
Oh yeah.
And so is small business sentiment. And we're hearing that. I hear that a lot through the conversations I have with members in different types of just my friends that work in business and our clients, we hear a lot of negative sentiment, negative outlook for next year. Don't know how we're going to make payroll or what we're going to have to do to make it. So negative sentiment is still really high. And yet the economy and the market are both have really strong indicators. JP, how do you explain it?
You know,
You on the spot.
I don't know. Yeah, you and I have a really interesting opinion about that goes back to demographics, where it's kind of the right confluence of events where we just have such a tight labor market that even though, if we were to look, I did pull up consumer sentiment when we were preparing, we're in recession level consumer sentiment territory, right? Like 61% of respondents, or the index of it is at 61. Oh, I clicked a button I wasn't supposed to, but the whole idea behind this chart is that people, rightly so, feel bad about the economy when bad things are happening, right? So like in 2008, we all knew something horrible was happening. People are losing their jobs, etc. But if we look at like current employment rates, right now we're at the historical average, which is about 3.94%. Like that's by all means a very strong economy. People are getting jobs, people's incomes are increasing, but everyone has this feeling in the back of their head, like, can we raise interest rates to 5% in a year and nothing bad will happen? I really think that's what it is. It's almost like a change in psychology, or kind of having to think back, okay, 20 years ago, 40 years ago, when interest rates were this high, we still had a growing economy, but it's just been so different from the way we do things now. And that's going to take some time to filter through the business cycle or the business environment.
I'll give you all. I would give you all that, and thanks for those answers. And I'm going to add to them. I'm going to say that, and probably things that through our conversations I know we agree upon, is that even though inflation is down, things are still really expensive, particularly food and gas, which Americans use the most of. Right, like
right.
That's a big part of our economy.
Right.
Two, even though markets are up, markets are so skewed towards a handful of companies that have really, it doesn't always impact the individual balanced, smart long-term investment strategy.
Right.
And then I'd say third, which you kind of hinted to, is Milton Friedman, I believe, said that, the long and variable lag of monetary policy. And so the true impact of monetary policy, of having very low interest rates for so long and then hiking them up to a very high point very quickly, we may not know the impact, but a lot of people know intuitively, like, this feels a little differently. Or even not even just intuitively, as a matter of fact, if I can divulge that you've been looking at houses to purchase a home, and it feels very different to buy a home now with 7% mortgage rates as opposed to 3 to 4.
Yeah, definitely. I mean, as a younger person, kind of building up those quote unquote starter homes and all of those things, the math has changed drastically on what anyone can afford. And obviously when the federal funds rate goes up 5%, that's kind of the floor, right? And the mortgage rates are typically above that. So we've worked with clients in the last year on buying houses, and we see mortgage rates about 7.25%. That's been kind of the average over the year. Sometimes they've gone up to 8, but really 7.25 is kind of 2023's normality for a mortgage. And you're going to pay like 170% of the home's value in interest over a 30-year loan with that kind of rate. So it's a very weird time where I think everyone's kind of sitting on their hands waiting for things to quote unquote get better. But who knows what that actually looks like.
Yep. So finishing or wrapping up one of our wonkiest videos, because this is pretty wonky. We're talking some pretty technical stuff. So let's we're not going to sit on our hands. We've got a little bit of tax loss harvesting to do this year across the board. Not that much, honestly, because we've been doing it. When the market had dipped a couple times this year, we had done our tax loss harvesting. We've got a little bit of that left. We have our final investment committee meeting, which is a formal meeting where we look at all of our portfolios and all of our strategies across the board. We have one more of those in December. And then we're just monitoring on a daily basis. Let's have some fun, JP.
Sure.
Santa Claus rally, yes or no? I'm going to define that as a 5% return in December.
Is it across the whole month of December? Or are we talking from like December 25th to close out?
December 1 to January 1, December 31st, the S&P is up 5%. This is a complete guess. We are not asking anyone to take our advice. We're doing some informal gambling. I'll bet you a coffee next time I'm in the office next week.
Yes, you can buy me a peppermint latte because it is going to be it's going to go up 5%.
You think it's going to go up 5%?
I'll take the over on that.
Okay, then I guess I get the under, which is less than 5% for the end of the year. I do not want a peppermint latte. I would like a green tea hot matcha.
Okay.
We'll see.
We'll do it.
Yeah. Good. I think what's most important for us and for our clients is to know because these videos are for our clients. Like these are not just general information. They go directly to our clients. Later, people, if they see them on YouTube, is fine. Is that we love everything we own. And we're buying value, even though there's this uncertainty. Will rates go up? Is there a long and variable lag? Will the mid-market banking crisis come back? Or will it be something else geopolitical? We're watching, but at this time, we love everything we own. And otherwise, we wouldn't own it for ourselves or our clients. So,
yeah.
And
to quote I want to end out to quote the late great Charlie Munger.
Yes.
Recently lost at 99 years old. He said that he likes to invest in wonderful companies at fair prices. And that's really what we're trying to do. It's diversifying portfolio of companies that we like at prices that make sense. So I think that aligns pretty heavily with what we've been doing.
Yeah. I mean, all the time. It's like, buy low, sell high. If it were just that easy. But Charlie makes it sound that easy. What I like about Charlie, and he said in this interview, was like he related a lot of the success to longevity. I mean, the guy started investing in his 20s and he's 99. If you have as long of a view as he did, and clearly a lot of resources and all that other stuff, but longevity goes such a long way. And having that mindset of longevity. And so we talk about annual reviews or annual returns, but really we should be, we know we're focused on 3-year, 5-year returns. And I think I'm talking too much, and people, if they've hung on this long, thank you. Please call us if you have any questions. We love working with you and hope to touch base with you during the holiday season.
Yep. All right, let's get back to work.
Let's do it. Talk to you later.
Bye.